Basically a credit score, specifically a FICO score, because FICO is, again, it's the most renowned credit scoring model. 9 out of 10 lending institutions use a FICO score to make their judgments pretty much about your credit and largely, unfortunately, about your character. Yeah, I mean, Lending Club uses a FICO score, for example. 35% is your payment history, which is the biggest part, and I think that's pretty self-explanatory. You're paying on time. Obviously, that's good. The other factors get a little bit murky. 30% being the amount that you owe, which is your utilization. Typically speaking, you don't want to have your utilization on any particular credit card, and this also translates to the aggregate, of being more than 30%. So for example, if your credit limit's $1,000, you don't want to necessarily spend more than $300 on that credit card. If your cumulative credit limit on all 8 of your cards is $10,000, you don't want to spend more than $3,000 total. And that doesn't include maxing out any card, because keep in mind, none of the cards you want to be above 30%. So that is the biggest way I have seen people from counseling detract their scores. And quite literally, I've counseled people 1 month and looked at their score. The next month, they've maxed out a card for various reasons, and you can see the score decline by 60 points or more. So it is a very serious contributor to your score, and because credit scores are a snapshot of your credit standing at any given time, you don't necessarily know when that snapshot is going to be taken and sent to the credit bureau. They don't necessarily want to see you owe money. It's not necessarily wanting to see you owe money, but you do need to have a payment history. Yes, so if your only credit is credit cards, which is rare, but if that is the only credit that you have, then you're going to want to charge something and either pay it off each month just to have a payment history going. But if you, like most people, have auto loans, mortgages, student loans, other types of debt, if you have a significant payment history with those, and particularly one that's going to be longer, which student loans, mortgages, auto loans provide you a payment history of years, you'll be okay. You'll be all right. Now, that won't necessarily stop them from reducing your limits. If you don't use the card and use up most of the limit, they will likely reduce your limit because you're not using it. But that's not necessarily negative. That does have ramifications, though. It's not necessarily the payment history. I mean, I see that a lot, but there's a lot of people that have on-time, perfect payment histories, never missed a payment over the last 15, 20 years, but they have a high utilization on their cards specifically. Because other types of debt, student loans, and pretty much installment loans in general, it's acceptable to have a large amount of debt because you take out a $500,000 mortgage, you're not going to pay it off tomorrow, right? So it's going to take you some time to work that balance down. Your length of credit history is a fairly important indicator of your credit standing. Usually when I counsel people, I like to tell them don't worry too much about that. You have loans of any installment loans of pretty much any kind that's not a personal installment loan, you're going to develop a long payment history. I mean, the bank is going to love you because you take out a student loan, you're paying them for 10 years. New types of credit, this right here kind of hurts people a little bit. Main thing to focus on there is don't just apply too much. If you do apply and you are denied, don't apply again. Pull your credit report and take a look at it. Again, I'm over at Consumer Credit Counseling Service once a month. You can always give me a call over there. But definitely examine the credit report first before you apply again, because chances are you could get denied again, or what we see a lot is that there's a mistake in the credit report. About 1/3 to 1/2 of credit reports have an error in them, so definitely check the credit report before you apply again. And then the types of credit used. This is basically looking for a mix of credit. So this component judges the score on having just credit cards, let's say, versus having just personal loans. Having a mix of credit is what you're ideally looking for. I give the example of having no more than 3 or 4 credit cards for your lifetime. Student loans, you have to pay for college, and then a mortgage, auto loans. Basically, other types of debt are necessities, so to speak, to help you get to where you're going in life. So with that being said about the credit score, the biggest thing to focus on, in my personal opinion, is of course paying on time and then the utilization ratio. Because that snapshot of your credit score is taken at any given point, it can benefit you to make large payments or pay it all off at once. Because for all you and I know, that information could be sent to the credit bureau tomorrow. And if it shows that you've paid it off, great. But if you're in a position where you're looking to rebuild your credit, I would say it's probably better to pay the smaller amount, maybe more than the minimum, but pay the smaller amount so you have a payment history that's prolonged. Because when you're in a position of rebuilding credit, you can't get a lot of credit at once to do that. If you are concerned about a mistake, you can go to annualcreditreport.com and pull your credit reports there. There's no score, but they are free every 12 months. It does allow you to take a look and see where the mistakes are. And then they put all the contact information in there for the credit bureaus. So you can call them by phone. TransUnion is really easy to get a hold of on the telephone. Equifax is also fairly easy if you just hit 0 to get through the phone tree. If you want to really get that extra oomph out the score, taking out maybe a personal loan and paying it back over the course of 3 or 4 months, or making the minimums on it to have the payment history grow with that is fine. But that's up to you. I talk to people with the high scores and I just leave that up to them. But typically you'll see that if you have just that one type of debt and you manage it very well, it's the fact of only having that one type of debt is what stagnates you there. The best thing I would tell you is check your credit reports every 12 months. It doesn't have to be every 12 months literally on the day, but let's say every quarter, or not every quarter, but every 4 months, pull a credit report from the credit bureaus. And then what I find to be kind of helpful, and it's up to you if you want to use it, but some sort of monitoring service. I know credit card companies offer those for a fee. Banks offer them, credit unions offer them. I bank at SFI, I know they do it. Doing something like that to give you peace of mind is also, I know a lot of people feel comfortable with that. Me personally, I'm comfortable with just checking my credit reports every 12 months, and that works for me. But a monitoring service, I find, gives a lot of people just peace of mind. Even though nothing may happen, it just makes you feel better.
Thank you very much, Calvin. This is such important stuff. You need to pay attention to this. An additional reason is life insurance companies and auto insurance companies, they check your credit score. And they'll adjust your rate if you're a bad risk. And the important thing, that's why I say go onto your credit cards and monitor them. Because if you report a bad charge, I don't know what the time limit is, but within a certain time period, they'll honor that. And you won't be liable for it. The financial services companies have mastered the psychology of encouraging you to spend and not feeling the pain.